Hey guys, what is up? My name is David and we are back with another stock analysis episode. Today we're going to be taking a look into DAVIDsTEA stock, ticker symbol DTEA. Now, first I'm going to go over their business model, then I'm going to go over their competitive advantages, give you a bit of insight onto some of the recent events and why I think this is a buy, give a bit of insight onto management, and then looking forward, why is now the time to buy this stock? So first, we'll start with the business model. And DAVIDsTEA has a very simple business model. They are a specialty tea retailer. And what this means is they essentially sell high quality tea, premium tea, and they do this mainly through physical stores, but they also have online and wholesale channels. Now, what makes DAVIDsTEA different from a lot of the other tea companies, specialty tea companies, is a couple things. These are their competitive advantages. The first part is they have these tea guides that operate at their physical stores, and customers, tea fanatics, love to the experience that they provide inside these physical stores. I've been in them. I can tell you they're very unique. Um, and the people, the tea guides, definitely know what they're talking about. The other thing is they are one of the only tea brands that sells loose leaf tea. And tea fanatics, they love loose leaf tea, or at least there's a certain percentage that do, and their number one choice is often DAVIDsTEA for this. So now we're going to go in a little bit to the recent events that have happened, why I think the stock is a buy. First, let's just quickly skim over the financials. Let's start off with the balance sheet, and this balance sheet is something which I think many investors are very scared away from, and let me expand as to why. So the first thing we see is DAVIDsTEA has $40 million worth of cash and cash equivalents. They're literally trading under their cash position. On the other hand, they have around 113 million worth of liabilities, and that is compared to their 90 million worth of total assets. Then again, we can see they have around 73 million of total current assets compared to 43 million of total current liabilities. So this company looks to be fine in the short term and very concerning in the long term, especially given this company's track history of not being profitable. So why do I think that this balance sheet provides us with an opportunity? Why is it that I think people are overlooking this specific sheet? So the first thing we see is there's a couple notes next to some of their liabilities as well as assets, of course. The one I want to go into more is the lease deficits. So their total liabilities. It says non-current portion of lease liabilities. So DAVIDsTEA right now is actually going through a Chapter 15 restructuring. And I'm sure many of you have absolutely no idea what that is, and I didn't either, but until I looked into this company. And essentially what it is the CCAA is assisting DAVIDsTEA in renegotiating all of their lease debt. Unlike long-term debt, lease debt can be renegotiated, and the prices that have been listed originally, so we see here it's around 70 million, it can be fully terminated. The good thing about DAVIDsTEA right now, as of July 31st, they terminated 90% of their leases under this restructuring. So hypothetically, we should see 90% of their debt go away because, of course, lease debt hasn't been used. They haven't actually occupied that space. It's future lease debt. So it's a future liability, and it's something they can restructure, which they've been doing. So turning to their income statement now, we can see that they had sales of 32 million for the quarter. The cost of sales, so they have a pretty high gross margin. It's above 50%, and yet they still took a adjusted net loss double what it was last quarter, I believe, if this is last year actually. And this is relatively concerning. Keep in mind that these numbers are mid-pandemic, and they're undergoing a restructuring of their entire business model as well. And this is why I think they have the potential to generate positive cash flow. 50% of their sales, or more than 50% actually, were done online and through wholesale this past quarter. And essentially, that means that their SG&A costs, which are sky high, should go down as a percentage of sales because they no longer need employees into their stores. They can just sell all of their items online. And since they have the competitive advantage, consumers will flock to David's Tea, and they have been flocking to David's Tea. So when we look at this statement, we can see that if their SG&A can get knocked down, this company will be easily profitable, especially because they need to pay interest on leases. And they had a one-time financing cost, and that was associated with the right of use assets being rewrote on the balance sheet. So you can ignore the $40 million worth of a loss on the financing costs. And this company really, it has an adjusted operating loss of $4.4 million, and that's not bad. It really isn't, especially considering that the fact that this is mid-pandemic and they lost a ton of money in terms of their physical stores. It's nice to see that online has been offsetting that mid-pandemic. So when we look at this last quarter, they generated some free cash flow as well, just because they're reducing their capex. So I think for this company, we need to kind of assess how good are their online sales, because now online sales are going to represent a large majority of their total sales. They only have 10% of these physical stores that they had um, even last year. So online sales should represent a high percentage of sales. So we need to see how well they can retain customers online. So the next question you guys might have is, how am I so sure that people are still going to their online websites and this wasn't just a fad from the whole pandemic now that everything is opening back up? Well, there's actually a website called SimilarWeb, which allows you to look at the traffic on different websites. And I've used this so far to track David's Tea site traffic. And over the past 6 months, it's grown immensely year over year. But in addition to this, we can see that the traffic is not declining at all within the past few months. I will be updating you guys when the September data comes out for this, which would be the whole month of August. And likely we will get a very good picture of the revenue numbers this company will put up next quarter in September. Other than that, I recommend you guys go and look at these different analytic tools if you are invested in other companies that mainly operate in e-commerce. It will give you a very good estimate on what sales trends look like before earnings even come out. That is a major advantage to investing into businesses that mainly go off of website sales. Management prior to 2018 had focused on expanding their physical retail stores, and I view this as a huge problem. Many investors did, because they were all not profitable. So now that they've terminated it, there's a whole slew of new people on their board of directors. They've all joined in 2018. They've been turning around the company very nicely. I'll give them a lot of credit for that. So where do I see this company going in the future? I think roughly we should expect around 100 million US dollars in annual sales next year, from their online and wholesale streams of revenue. And that's probably being conservative. And that also discludes any revenue from their physical stores. They still have 18 physical stores that are reopening in Canada, in around 7 different provinces. So just taking their online stuff, if they can get a 10% profit margin, which is not very high, I think it's more than doable considering their gross margins already improved mid-pandemic. So I think anything under $1 for this company, even $1.50, depending on the news that comes out of their next earnings, is likely a buy. And I think in the next year, you can expect a 2 to 3x of your money, as long as odds are in your favor, which they are. There's a very high probability of a 2 to 3x and a very low probability of a permanent loss of capital. So I think this is a very overlooked play, partially because it's a small cap, partially because they're changing their business model, and partially because supposedly they're in bankruptcy, but it's not really as daunting as some would imagine, considering their cash position and they literally have no debt. So I recommend you all to do your due diligence and invest intelligently. I hope I gave you guys some insight onto this wonderful company. And if you have any questions about the company, please leave them down in the comments below. I'll be sure to get back to each and every one of you. And as always, please be sure to like and subscribe to show your support. This channel has been growing massively over the last couple of months, and I really, really appreciate it. I cannot thank you guys enough. With that, please invest intelligently, and I'll catch you guys in the next one.